resume the recording here. All right, everybody, welcome to Business Valuation and Analytics, part of my Bulletproof Bookkeeping webinars series. And the idea here is to talk about what you can do with a set of books after you've made them bulletproof, right? You can't really, there's no point in doing analytics and analyzing the numbers if you don't have a good set of numbers to analyze, right? I mean, I guess that goes without saying, but I want to make sure that's crystal clear. Step one, we need accurate books, right? Step two, now the whole point is to analyze them, right? In our accounting industry for years now, we've been told this, that we need to be the more strategic advisor. We need to provide the strategic guidance. And this is really what I believe is meant by that. It's really working with business owners and analyzing their numbers and interpreting them and looking for areas that could represent problems so we can head problems off at the pass before they get out of control, but also identifying opportunities, right? And so I'm going to talk about some of the high-level, most obvious things that we run into when we're doing this kind of stuff. We're just going to use the QuickBooks Online Test Drive Company today. So I will share my screen. And we're going to start with the basic reports, right? We're going to start with a balance sheet, and we're going to start with a P&L. This is hilarious to me when I'm in QuickBooks Online and Google asks me to translate the page. I want to know what language it thinks it's in. Oh, it thinks it's in Spanish. Interesting. Very interesting. Anyway. We'll run the profit and loss, right? And now it's just real quick, because again, this is the Bulletproof Bookkeeping webinar series. The Bulletproof Bookkeeping course, I was just talking with Hector Garcia actually earlier today about this, because he was asking me, like, who's this for? Is it for, the new bookkeeper who's coming in and looking to set up their services, or is it for somebody who's seasoned, or is it for the business owner? And I said, it's really all of the above. And he kind of looked at me like, how could it be for all the above? And the answer is it's all in how I designed the course. And I designed the course to be a reference tool where you could go, there's, small bite-sized lessons. So you could go look for that one specific thing that you need to learn or review. But it's also designed in such a way that you can just go through it sequentially. And the question he asked me was, was that actually, how should I go through the course? And I said, you could do it either way. So if you're the new bookkeeper who's really looking to learn this from the ground up and start a bookkeeping practice, then my suggestion, I said to Hector, was go through one lesson a day. Or like you can see the first few lessons here, 2 out of the first 3 are fairly short lessons, right? So you might do all 3 of those in a day. And I suggest going through them slowly like that and taking notes, and going through them. But this really lays out the foundation, starting with the bank feeds, because that's the core of everything these days, especially with cloud accounting software. Everything centers really around the bank feeds. That's where it starts. And then it goes through the whole range, so that by the time you're done with this course and you've learned how to do everything that it's teaching you how to do, even down to maintaining your books and understanding how to use the balance sheet properly as your checklist for going through the books and making sure they stay bulletproof, then you'll have it. Then you'll have all the pieces put together for how to get a set of books set up and maintained in such a way that they're bulletproof, which in short means I can prove every number in every one of these financial statements, right? So that's the caveat. And if you go to new.nerdenterprises/store, I've put it in the chat, I'll put it in the description when I post this recording. That's where you can find access to all of my courses. There's Bulletproof Bookkeeping. I just released Property Management with QuickBooks Online. There's 97 and up for the accounting or bookkeeping professional if you haven't joined. And then I've bundled the Bulletproof Bookkeeping and the Property Management courses, so you save a little money if you want both. And I just released 97 and up for business owners. So this is the comparable program to what I've been doing for accountants and bookkeepers for a few years now. But some business owners have asked me, seeing me comment about this program, they've asked me if it's something they could join. And when enough people ask you to do something, you do it. And that's really where this comes from. A number of my business owner colleagues and clients have said to me that they would love to have a program like 97 and up that was geared towards the business owner rather than, the accountant or bookkeeper. So that's all there. Of course, if you have any questions, you know how to find me. I'm easy to find and reach, and I'm always happy to answer any questions you have, especially in terms of trying to understand what my resources are and who they're for and whether or not or what is the right thing for you. So once we have a good solid set of books, one where we could rely on the numbers, then we can make intelligent decisions based on those numbers. And here's where that starts. And one of the most common questions I get from my business owner clients are along the lines of, and I posted something about this on LinkedIn yesterday, but they're along the lines of like, I've made all this money, I owe all these taxes, but I don't have the cash in the bank, that I feel like I should have, to reflect all this. Especially, I don't have enough cash in the bank to pay the taxes that I owe. How is that possible? Where did all my money go? Right? And so the first thing I'll do when I'm analyzing a set of books, and that's what I mean by analytics, is really just analyzing the books, learning how to read these financial statements in a way that we can get the answers to those questions, right? So the first thing I'll do is, let's take the balance sheet, but it's not really that useful just looking at it in total, with the way the standard balance sheet looks, right? I'm almost always going to want to run these things totaled by month. And then I can start getting some meaningful information out of it. Now, clearly, when you look at this instantly, you can see that this looks like a company that just started this year, right? That started in the month of May. And it looks like we opened up the bank account with $5,000, right? But we can certainly click in here now and confirm it. Yep, that's the opening balance, right? And notice it goes to opening balance equity. I had a funny conversation while the Bulletproof Bookkeeping course was in development, where some CPAs told me that the balance sheet I was showing a screenshot of couldn't be bulletproof because it shouldn't have opening balance equity on there. And I was kind of like, wait, you guys are CPAs, right? Like, presumably you understand this stuff, and yet you're making yourself look terrible when you make a statement like that, especially publicly on Twitter, as it was. Of course, it's fine to have opening balance equity. That's exactly where you put something. Case like this, I might be inclined to put it towards owner contributions, but there's absolutely nothing wrong with having opening balance equity, especially if you're taking an existing account and transferring it onto the books of the business. That's exactly where those opening balances should go. So, and it's important, I think, to have this understanding, especially if we want to have intelligent conversations between the accountant and business owner about these very things, right? That was another thing Hector and I were talking about a little bit. If you're a new bookkeeping professional just coming in, you might think, well, do I really need to understand all this debit and credit stuff, or can I just use QuickBooks and record invoices and checks? And the answer is you can, but at some point, your business owner client is going to question you on the numbers that you've got. Remember that when you're entering all this data into a product like QuickBooks Online, there's output that's resulting from what you've entered in, which are the reports like the one we're looking at now. And at some point, sooner or later, your business owner client is going to question you on the numbers. They're going to say, I don't think that number looks right. Can you show me how you get that, right? And you would, if they were questioning the starting balance, you would click in like we just did a second ago, and it becomes very clear very quickly. And I'm sure the business owner's memory would be jogged at that point and say, oh yeah, that's right, that's when I opened the account. And I've had that exact conversation with clients. I mean, they'll question everything. You have to assume they will, right? And that underscores the importance of understanding how to keep bulletproof books, because you really need to be prepared to prove every number that's your work product. Right? When you're putting together a set of books, the balance sheet and the P&L are essentially the results of your work. And so you've got to be prepared to confirm and prove every number that you put on there, because that's your assertion. That's what you're telling your business owner client is what they have in the bank. And obviously we verify bank accounts by reconciling the statements every single month to make sure they're accurate, right? Now look at what's happening here with accounts receivable. This is an interesting one and could potentially explain why cash is locked up. It's the first place I go when somebody says, I don't think I have as much cash in the bank as I should, considering how much money I made. Look what's happening to their receivables. So it's very possible, since the receivables are steadily increasing every month, it's possible, not definite, but it's possible that that's where their cash is, that it's locked up in uncollected accounts receivable. But you can't determine that just from looking at this alone, because what this could represent is money cycling in and out, right? This could represent, it could reflect the fact that all the past receivables were collected, that what we're looking at here in the month of October, for example, includes very little of what was in the receivables at the end of September. In other words, all of this might have been collected in October, but we've just invoiced that much more during October. So it's not guaranteed that this is what that means. It's possible. And that's why we have to dig a little deeper in analyzing these numbers, right? So I could look at a profit and loss, for example, for the same period and total it in the same way by month. And I can see what's going on is the revenues were kind of low in the first few months, and then boom, they jump up in September, right? And if we compare the revenues with the receivables, we have in the first month, June, 401.75. Well, in the first month in June, we only have 131.25 in income. That actually should start raising some questions. How could we have more in receivables than we did in income in our first month of business? Well, let's dig in and see what's going on, right? Here I have 2 invoices in June, totaling the 401.75. So why isn't my income for the month of June 401.75? Actually, if I go a little further down, the total income is 391.25, but still not all of it there. Why? I'll tell you why. When we click in and look, the difference between the 401 and the 390 and change is going to be sales tax, right? And so it's really important because, again, this is the kind of stuff that as the accounting professional, your business owner client's going to question you on, right? Especially when something jumps out. And it's really easy to analyze the books when you're in your first year of business because, things should kind of line up one for one, right? So the difference between 401 and the total income, which initially I was just looking in the top section here, but that's just the job materials. You got to make sure you're looking at the total income. 391, 401 is a $10 and change in sales tax. But you have to understand how to analyze these financial statements and then drill into the details the way I just did to be able to explain things, right? Now, I also want to speak to the question of business valuation. Let me pull up the chat here to make sure in case those of you who are here sort of live, if you have questions, make sure you use the chat and I'll check for that and I'll answer them. So again, you need to be able to drill around and understand where to look and how to drill around to be able to prove the numbers that you have, right? And Jalal in the chat says, I love my supporting documentation for that reason. Absolutely. When I was having the conversation I had earlier today with Hector, we were talking about how, Hector was sort of suggesting that as a seasoned accounting professional, you may not be held as much up to scrutiny on the part of people who you're doing the work for in terms of, having to prove your numbers. But I would even argue there that, I've taken over companies' books and looked at some of the entries that, their CPA or enrolled agent may have made when they did the taxes. And I've been surprised how often when I reach out to them and say, hey, do you have a work paper on how you came up with this entry? Because I don't really understand what you're trying to do. And they can't provide me with that. And that goes back to Jalal's comment. If I ever prepare any kind of an entry, especially if I know it's complex or if I know there's even a chance it might not be crystal clear when somebody else looks at what I did, by way of looking at it through the books, if I think it's even going to be slightly complicated to understand, I always have some kind of a work paper, which can just be notes that I've written, or it can be a spreadsheet explaining how I came up with my number. But I always have some kind of a supporting document. I learned to do that as an auditor, which is how I learned how to keep bulletproof books, because I had been on the other side of that when I first got out of college. And so I understood how auditors scrutinize the books. And years ago, I said to myself, well, if I kind of follow the same process that auditors use in scrutinizing the books and put together the books based on that kind of process, then I should have a solid or bulletproof set of books, no problem, right? And that's the process I follow. And there's heavy emphasis, of course, on the balance sheet and making sure that everything on the balance sheet is 100% accurate. So we need to be able to do that. And we need to really understand what we're looking at, so that you have to assume the worst scrutiny. You have to assume a client's ready to fire you because they're questioning your numbers and they don't believe that the work you did was solid because they don't think the numbers are right. And under that kind of pressure, you need to be able to come back and prove it. So I always have supporting documents to confirm. If it's not as clear as here's an invoice that totals up to the income number, then I'll have a document that shows how I came up with the number that I came up with, especially whenever there's any kind of a journal entry or adjusting entry, right? So, looking at that, again, we also need to understand the relationship between the balance sheet and the P&L. And I just really underscored, without pointing it out until this minute, that there's a very direct relationship, of course, between our income and our accounts receivable, right? They're directly tied in. I invoice somebody, it goes into accounts receivable, they pay me, it comes out of accounts receivable and goes to cash, right? So one place that cash can be tied up when my business owner client thinks that they don't have as much cash as the financials seem to say they should, it could be because it's tied up in uncollected accounts receivable. And the next place I look is inventory. It could be tied up in inventory, right? This will start happening a lot this time of year, right? It's October. We're gearing up for the holiday season. a lot of companies who sell inventory, especially if their company is seasonal and their inventory is the kind of inventory that sells more during the holidays than other times of the year, they're going to be stocking up on inventory by now. And that means you're going to see cash get locked up. So you may have high profits, right? And you may even have collected everything, especially a product-based online business these days. There are no receivables, so it's not like there's uncollected receivables, but they're going to tie up a lot of cash in the inventory. Why? Because we plan to blow through that inventory over the next few months, much faster than we normally do during the rest of the year. So we do that. We knowingly lock cash up in inventory because we want to turn it over, right? And that word right there, turn it over, turnover, is the key to understanding really how to look at analytics for a business. And there's a few main levers that we can look at that can be pulled to improve cash flow, for example. One is we increase our accounts receivable turnover. How long on average does it take us to collect the receivable, right? And there's a formula for that. I can look at my accounts receivable and I can look at my net credit sales. So if I look at this company, let's assume all the sales are on credit for the sake of argument, right? So I have $10,200 in sales. I would take my beginning and ending accounts receivable, which let's just call it 5,600, and divide that by 2, which gets us to 2,800, right? And then you divide that number into your net credit sales. So 2,800 into 10,000 is a little more than 3, right? What this is suggesting is that, and it's not an exact measure, but it's a rough idea, and it's a lot more accurate when you have a lot more data, not so much on a brand new company, but what that's suggesting is that our average receivables turnover is about 3 days, right? And if you dig in, you'll see that it's more than 3, but it's less than 30 in most cases. I've dug around in these sample books enough times to know what's going on here with their receivables. And you find most of them are collected like within 10 to 15 days, right? Like I said, that formula for calculating receivables turnover, much more accurate when you have a lot more data, and certainly a full year. It's kind of assuming a full year's worth of data in using that formula. So the other way is to just run another report, which I'll show you. And this is a cool report that's in QuickBooks Online, which is right here, invoices and received payments, right? It's right in the Who Owes You section under the reports. And you can look at this and it shows you the invoice was the first. This one was actually collected a day later, right? This one was invoiced on the 17th, collected November 11th. So like, 2-3 weeks later. Okay, here we had an invoice on the 17th. A month later, we issued them a credit memo for $100, right? And no payment. I don't know where the other 105 is. I guess that's sitting somewhere else on the books. So again, if I want to research that and say, where is that? How are we getting to 0? The invoice was 205. We issued a credit for 100. There's another 105 sitting out there somewhere. And there it is, this payment here. It's a little confusing the way it's laid out. But here's the other $105. So that was on 9/11. So it looks like we got paid on the 11th. Maybe they complained about something and we issued them a credit memo almost a week later, right? So this report lets you pretty quickly analyze the timing of everything for each client and each invoice within that client. Great report to look at, especially once you've got some data in there. And now let's talk about, first of all, let's talk quickly about business valuation. We're going to give you the quick answer first, which is that there's your business valuation right there. That's the book value of the business, is the total equity, right? And again, critically important that we have reliable numbers in here, especially if we're going to tell somebody that right now your business has negative net worth, meaning that they've taken more money out than the business has earned. And how's that possible? Because I can put money in, earn a bit of a profit, and then take out, more than the profits in terms of trying to get back the money I put in. So the total equity consists of opening balance equity, which is negative, and the little bit of net income that we've made. So how can this be negative? I probably transferred debt on the books, right? Or in this case, I transferred inventory onto the books, and I've got some other journal entries with big negative balances. This was the bank account that we started off with. This is another opening balance we're putting on. So that's all this is. And we could go piece by piece and say, all right, well, what's this $25,000? We did transfer a big chunk of debt, a note payable, onto these books. So when I transfer a liability onto the books, that's going to reduce equity. It's going to reduce the net worth of the business. I'm putting a burden onto that business and saying, you now have to pay this off, right? So it's important to understand how to look at that, and it's important to understand how we arrive, because this is definitely going to get questioned when you go over your balance sheet with your business owner client, especially if they're savvy enough to know how to read and look at this stuff, right? So really, really important. This is the net value of the business. It doesn't necessarily mean it's the market value. It's just the book value. It's if you take your total assets, right, which is up here 23,000, minus your total liabilities, which is 31,000, right? 23 minus 31 comes out to -7. Okay, so again, that's the book value of the business. Just want to make sure that's clear, because we did talk, this is business valuation. But again, that's not the valuation you're going to get if you're looking to sell the company necessarily. That's a totally different thing, which we'll talk about. So let's talk about some other analytics that we can look at on a set of books. I'm going to, again, take this balance sheet. I'm going to total this by month. And I'm going to quickly drop this into Excel. And by the way, keep your eyes open. They're rolling out, it's in beta, an option to export reports in QBO to Google Sheets. So depending where you are, and I guess it's probably, they roll these things out regionally, so not everybody has it yet. But I've seen in some cases where the option's available and in other cases where it's not. So for now, we'll export to Excel because that's our only choice here. And when you're doing any kind of analytics, they're honestly kind of worthless without having some kind of a comparison, something to compare it to, right? We can quickly kind of shade out these months because this is before the company really got started. So I'm just going to do this, just so I have a clear kind of cutoff what I'm looking at, right? And we're going to start with kind of the obvious, lowest hanging fruit, what people typically look at when it comes to these things. Let me also quickly freeze my pane so I can see what's going on above. And we're going to start with the current ratio. And then we're going to look at the quick ratio. What these ratios are doing in general is measuring liquidity. And again, it's not that it's totally useless to look at what the liquidity is as of today, but it's a lot more interesting to look at what's happening to that liquidity ratio over a period of time, right? Which is why I always total these things monthly. So the current ratio is simple. It's simply going to be your total assets. The total current assets. That's why it's called current, divided by your total current liabilities. Where is it? There. Okay, we're going to get an error on this one because we're dividing by 0. That's okay, because that was our first month in business, right? But now we're getting some interesting numbers. Let me just format these a little better. Okay, so in June, what this is saying, by the way, is I have enough in current assets to satisfy my current liabilities more than 17 times. I don't care what industry you're in, that's a pretty good liquidity ratio, right? And that's really what this is measuring, is how easily would I be able to settle my debts if I needed to, right? And in other words, how liquid is my company? How much cash do I have compared to my liabilities? It's also a good measure of how well poised I am to take advantage of opportunities if they should come my way, okay? And so if we look, it starts off great in June. May will discount because all we did was put $5,000 in the bank. But June, we're looking really good. How is that possible? Well, we had 5,000. A little bit of receivables came in because we started invoicing customers, right? And all we had for liabilities is a little bit of accounts payable, right? And then a little bit of sales tax payable. That's the $10, right? Remember what we looked at earlier? So starting out, our assets and compared to our current assets compared to our liabilities is huge. We had plenty, right? It jumps up much higher still in July, but notice what happens here. Now it drops down. And this is very common on a new company because what's going to happen initially, all I have is assets because I'm contributing cash. We saw entries in opening balance equity for contributions of inventory, right? And all that's included in our current assets. So let's take a look here and see in the month of July what happened, right? Going up here, we still have most of our money in the bank, right? A little bit more accounts receivable plus some undeposited funds, which is really same as cash. It's money I've received that I just haven't put in the bank yet. Okay, no inventory on the books yet to speak of. It looks like we paid off our accounts payable, right? That's probably most of what depleted the cash. We also threw some stuff on a credit card, Okay. And we also have some more taxes payable because we had more invoices. Okay. And then we have that opening balance equity, which isn't factored into any of this because it's just assets and liabilities that we're comparing and only the current ones, right? So our ratio improves. Why? Because our cash only went down a little bit, but everywhere else the assets went up, right? And if you look at what we increased receivables and undeposited funds by, $769, that outweighs the drop in cash. The drop in cash is only a few hundred, right? So our assets actually got increased, but our total current liabilities decreased, right? And we're dealing with small numbers here too. Keep that in mind, so that a swing in a ratio when the numbers are small is not as significant as when you're looking at a company where you're talking about, tens of thousands or even millions of dollars. Then obviously, it takes more to have an impact percentage wise on the numbers. So keep that in mind too. You have to have the whole context. You have to really be thinking about the whole picture here. So it may look like a very dramatic swing, especially when we start going back down again. But the truth is, it's not really that dramatic when you convert it to dollars, right? Because we're dealing with small dollars in the first place on this stuff, right? So the bottom line is now we get to the current month of October, which isn't done yet. So the first question I would ask if I was looking at this with somebody's bookkeeper is, I'd say, is everything current? Are all the bank feeds up to date? Again, that's the starting point. That's the core. If the bank feeds, meaning all the bank accounts and credit cards, completely up to date, then we've probably accounted for most, if not all, of the transactions from October 1st until today. And if that's the case, then I know this is a reasonably reliable number, and the month is almost over. Whoa, what happened? Well, remember, we transferred, and actually this doesn't factor in because this is long term, so never mind that. But our total current liabilities in comparison to what they were before jumped up big time, and most of it is because of this note payable, right? So now all of a sudden our liquidity is much closer to 1 because our assets are about equal to our liabilities, current, right? Current assets equal to our liabilities. We also have some inventory on the books. We also added a truck to the assets. And that's probably, and again, this is how you learn to sort of think around the whole picture and start connecting the dots, right? Well, that's curious. I put a truck on the books, and I also put a long-term note payable for 25 grand. I wonder if these aren't related. I wonder if that note isn't, the note that I took out to pay for this truck, although it's a lot more. And maybe the $4,000 note payable is for the truck, and maybe the long-term note payable is for something else. Probably, that's more likely to be the case considering, the numbers. But this is how I'm always thinking when I'm looking at these financial statements is I'm remembering what I've just looked at elsewhere as I'm moving forward, because I'm trying to connect dots. It's very common if I put a vehicle on the books, or if I put any significant asset on the books, that there might be a liability associated with that asset. That's probably how I acquired it, right? So it's very common if I see a truck get added to the books that I'll probably be looking for a note payable that relates to that truck, right? Either that or a big drop in cash, either that or something big in opening balance equity. And sure enough, there it is, right? We went from 5,000, which was the cash contribution into the bank account, to 19,000, difference of about 14,000. The truck value, about 14,000. So I don't even have to poke into, although I would to confirm it, but I don't have to necessarily poke into the details to figure out what's going on just by looking at the balance sheet, right? And also and remember our starting point after we calculated the formula. I'm looking here, what made us go from being so liquid to so illiquid, right? And it's not really that 1.62 is so illiquid. It means we have enough to cover what we need to, right? That's what this is telling me. So, and wait, let me go back up before we get into the quick ratio, because I could have sworn I'd seen inventory come into the books. Here, just a very small amount in October. But the point is we have inventory, which is going to help me explain the quick ratio. Because what the quick ratio does is it says, okay, we're going to look at what the current ratio looks at, but we're going to assume that the inventory isn't as liquid as everything else in the current assets, right? Inventory might take a while, or I might not be able to sell it at all, right? What we're looking at when we talk about liquidity is stuff that either is cash or it can easily and quickly be converted to cash, like a receivable that you figure should be collectible. And certainly money sitting in undeposited funds, that is same as cash, right? So what the quick ratio does is it simply excludes inventory from the equation. And that's obviously it's more conservative, right? So I'll start with this formula, and I'm just going to copy the whole thing and paste it in there. And then I just want to remove inventory, and remember order of operations. So I have to do that part in parentheses. So G19 minus, where's my inventory line? Minus this cell, which is G16, in parentheses. I have to make sure it does the subtraction first, right? So I put that in parentheses, divide it by the current liabilities, right? And now I've got my more conservative ratio, which until we get out to October where there is inventory, the results are all going to be the same. Then, of course, when it does actually have inventory to factor out, now we get a difference in the calculation. And now you can see why the quick ratio is a little bit more conservative, because like I said, it's assuming that inventory may be a little harder to convert to cash. So this kind of puts the business under a little bit more scrutiny in terms of analyzing its liquidity, right? So the key to this in studying and analyzing the liquidity of a company is looking at it, looking at the trend over a period of time, what's this doing? And comparing that to what we understand about the business, which, by the way, underscores why it's so important, I think, for the accountant and the business owner to do this analysis together. If the accountant does it alone, and then, yeah, you can do it and then send things to the business owner, but it's highly inefficient because now you've got to go back and forth and get insights that the business owner has that you as the accountant might not, and vice versa. You do it together, you can get to the bottom of things quickly. This is very normal, especially the fluctuations, like I said, when you're starting a new business, right? You're going to start that new business contributing all kinds of assets. Normally you won't have a whole lot in terms of liabilities, but then over time you start to generate some money and use that money to buy more stuff for the business. And so then things change, right? And the more time you have to analyze this over, the more useful the information gets. But the main thing is understanding that I want to analyze this over a period of time, right? So that's the key here, is looking at the trends, because what do you think is better for something like a current or a quick ratio? Do we want it to increase or decrease? Obviously, we want it to decrease. Obviously, we want it to increase. We'd like to be more liquid. Now, something to be careful about, because it's easy to assume that more is better, but that's not always the case. At a certain point, if my current and quick ratios get to be so high, like let's say they're like 100 times, that could actually suggest inefficient use of our resources, right? If we just accumulate cash forever in the bank account, it's not necessarily indicative of a good management strategy on the business. It could be that we're not putting our resources to use. We maybe could be spending that money on advertising or spending that money on equipment that we can use to run more efficiently. There's all kinds of things. So don't assume just because generally speaking and on the surface it seems like the better this ratio gets, the better it is for the company. That's true up to a point, but there's also a point that will cross over, and that's going to be something you'd have to analyze business to business and industry to industry. But at a certain point, having a really high current and quick ratio, not necessarily a good thing. Like I said, when you cross a certain threshold on that, it goes from being good because you're liquid to being questionable in terms of how well you're making use of your most valuable resource, which of course is cash, right? So really, really important to keep that kind of stuff in mind, right? And then another thing to look at is just the equity by itself. What's happening? Here we're building because we're contributing all kinds of stuff. And then boom, equity flipped the other way. We already analyzed why. We put a big chunk of debt. We transferred a big chunk of debt on the books. Normally, putting debt on the books wouldn't have this kind of impact, because if I take a note payable out, it's offset by the cash I've received from the bank. So I increase an asset by $25,000 and I increase a liability by $25,000. So it has no impact on equity, right? Because they wash each other out. Assets minus liabilities equals equity. And so 25,000 minus 25,000 equals zero impact to the equity section. The reason this happened is we put a big chunk of liabilities on the books without the corresponding asset coming in, right? So instead what we did was we reduced equity, because we basically said, I'm going to guess, if this were a real company, my first guess would be, and this is why it's important to have the owner there because I can confirm it, is we took a personal loan and threw it onto the books and said, now the company's going to pay this loan off, right? And maybe it was a loan that they took out to buy a truck a while back that they're still paying off, although that wouldn't be for this truck because it's too much money, right? We kind of went over that before. But maybe that's what this was all about. So again, it's useful to understand what to look for and how to analyze this stuff. Even more useful to have accountant and business owner there together so they both can do the analysis. The accountant kind of knows what to look for and how to interpret this stuff. The business owner knows what's going on with their business. So between the two, you can really get the whole picture put together kind of nicely and very easily. Now, another thing we want to look at, let's go back to QuickBooks. Let's go to the P&L, and we're going to dump this into Excel now. The other day I put a video up on LinkedIn and I was talking about a bunch of stuff. I was talking about that core problem that business owners often have. Their biggest complaint that I hear, which I mentioned earlier, is, hey, I made all this money, I got to pay the taxes, but I don't have the cash, like what happened? And I referenced the fact that another way that your cash could be getting sucked out of your business is if you're highly leveraged, right? If you've got a lot of debt on the books, you could be making a profit, but if a lot of that profit now has to be used to pay off those liabilities to service that debt, then that's another reason why you could have made a lot of money and not had much to show for it, because a lot of it had to go to pay off debt, right? And I bring that up because it's I mentioned in that video that there are sort of good reasons for taking on debt and bad ones, is the best way I can put it. So a good reason for taking on debt is that there's going to be a return coming from that debt, right? In other words, like I mentioned before, if I take on debt to buy an asset and that asset is going to help me generate revenue, then I have a return on asset, right? And that's what I want to be able to look at. So one of the first things I like to do when I'm looking at the P&L is I can take this net income line right off the P&L. Right, let's bring it back over to the balance sheet. Let me just drop it in here. And trust me, normally I would be much neater about this, but it's just in the interest of time. We're going to paste the values. And what I want to really do here is I want to take my net income, and let's label it so we know what we're looking at. But my net income for that period divided by my total assets. And somehow I'm off by 1 here. What happened? This goes, oh, because of the total. Duh. All right, so I didn't want that one. That's just from the total. All right, this is going to be return on assets, ROA. Take my net income divided by total assets. Wait, was I in May? No, of course not. Okay, now this is a measure of how efficient our assets are, right? Are they generating revenue for us or aren't they? So again, this is another ratio we hope to see increase, right? It might decrease it when we've taken on a major fixed asset, right? Maybe we buy a new truck because that truck is going to help us make deliveries or whatever it's been acquired to do. So in the first month when we acquire it, I would see this dip that would be expected, but then I should see it turn back around, right? So this is another really useful ratio to look at, and again, especially in terms of the trend, right? So it dropped down big time here, but then it looks like it's jumping back up in October, right? So what I want to do again is I can see what happened income-wise, right? Income-wise, we actually dropped to a loss here. So I would expect to see something like that, assuming the assets were about the same. But here we have a nice chunk of income, right? And then let's look at our total assets. And by the way, if you're doing an analysis like this, and especially if you're the accountant doing it and planning to present it to the client, it's sometimes useful to just copy some of these lines down to the bottom so you can summarize it all, so you don't have to keep scrolling up to see, what the numbers were above. But here I can see my assets are steadily increasing, and then they really take off in September when I added the truck into the assets, right? Nothing else increased too dramatically here, right? And even the inventory we acquired was very little, right? That was in October, but still we have a nice steady increase in assets, and so but which also suggests that if we're not doing well income wise, if we keep increasing assets, it's going to be harder to show a nice return on assets, right? At a certain point, we have to stop acquiring assets and see the return come in, right? And that's the point. So I don't mind taking on debt to buy an asset that's going to produce a return, right? What I don't like doing, and if you ever watch shows like the Shark Tank, it's very clear that they don't like borrowing money to meet payroll, right? If you have to borrow money to meet payroll, granted, you have to do what you have to do, but it's not a good sign of a healthy company, right? Again, there's a good use of debt and a bad use of debt. When you're borrowing money to cover payroll, you're putting a Band-Aid on a wound, which obviously you need to take a closer look and figure out why is it that we're at that point where we've got to borrow money and cover payroll, right? Why aren't our cash flows able to come from operations? And that gives you a clue as to the next report I want to take a quick look at. Let's just duplicate the tab. Right. And quickly before I move on, Jalal, I just saw your comment. So yes, if you take distributions out, actually the distributions won't impact these ratios because none of these are taking equity into consideration. That's actually kind of the point, but it still underscores an important point, which is that when owners take distributions out of a business, it sucks the equity out, right? And another thing we also want to look at where that will show up very clearly is return on equity, or ROE. And that's going to simply be, it's basically the same formula or same idea. You take the net income divided by your total equity line and see what that's doing, right? And so return on equity is important to look at because if the owner is taking a lot of distributions out, you're going to see that return on equity drop, big time, especially if they're sucking all of the income out in the form of equity, right? But return on assets, the distributions don't have any impact on the assets, of course. So you won't see any kind of an impact there. Back to here, the other thing I want to look at is, because I mentioned this, you want to make sure that cash flows are coming from operations ultimately, right? It's not the end of the world, especially on a new company, if they aren't. In fact, it's very common. You think of a new startup, right, in Silicon Valley or something, where none of their cash flows are coming from operations because they're living off of venture capital and funding that they're getting in a lot of cases. I love the fact that QuickBooks Online gives us the ability to total this report by month. QuickBooks Desktop does not. I checked recently, still doesn't. Because again, you want to be able to analyze the trends. This one's a little harder to understand for today's purposes. I'm just going to jump to what I referenced, which was the cash provided by operating activities, which is this line here. Suffice it to say that you want this to be where the cash flows are coming from. Over here in financing activities, you can see we transferred that debt onto the books. That meant a positive cash flow. That's why it's positive here. But we also put, what do you call it? I don't think I said that right. We put a liability on the books, but it had no impact on cash, right? And then over here, the other opening balances we put on the books, including adding, well, let's click in so you can see exactly where this is coming from, right? So we have the $4,000 note and we have the $25,000 long-term note. These all are negative cash flows in effect because we're putting liabilities on the books, but we don't actually pay for them. They don't actually impact cash. So that's what the statement of cash flows kind of does, is it looks at things that are included in net income or not, but that, in other words, are not reflected in the P&L, but that did or didn't impact cash, vice versa. So you look at accounts receivable, and there's net income that's uncollected in accounts receivable, so we have to subtract that out in this case. And which way this goes depends on whether we invoiced more or collected more during that month. So these are the kinds of things you want to start looking at to understand what's really going on with a company, right? So most of the cash flows came from operations. We had negative cash flows from financing activities because of the net, negative 28,000 that's in here compared to what's here with the note payable, and that's getting compared with opening balance equity. And that's what's really happening. So I'm sorry, because I feel like that was a little confusing. But here we transferred a note payable onto the books, And then here it gets offset along with some other things, because at the same time, we put that into opening balance equity, right? So this is the opening balance equity impact, which is offsetting most of your note payable impact, right? That's what's actually going on here. So again, looking at this, we want to be able to see that cash flows are coming from operations. If all the cash flows are coming from financing activities, that means that the owner's putting money into the business, right? And that's not good, because the owner presumably only has so much money to put into the business. And bottom line, even if he has all the money in the world, he or she is not going to keep putting money into the business if it doesn't at some point turn around and start making a profit, because eventually they want to see the cash flows coming from operations, and they might want to see some kind of a return coming back on that investment that they made into their business, right? So there's a ton of ratios that you can research and use to analyze. Another thing I like to look at, and let me see if we have a good example of what I'm thinking of here. I'm looking to see if we have payroll on these books. There's sort of payroll ratios you can look at. Or another thing you can look at is, let's take this gross revenue line. Where's total income, right? And I'm just going to paste that down to the bottom. Like I was saying earlier, sometimes it's useful to do that so you can just work with it. So there's revenue. And then we want to look at number of employees. This is theoretically a measure of how efficient your workforce is. So let's say in month 1, the only employee is the owner. Month 2, month 3, same thing. Then all of a sudden we hire maybe 2 people, then maybe another, or maybe we hire one more person and then another person. And then let's say here we've got 5 people. And we want to look at revenue per employee. You start doing this kind of stuff with your business owner, they're going to love you, because it really gives them a good gauge, right? And this would look really good if this was truly the case, because it means that each month, even as we've hired more people, it dropped here when we hired just the one more person, but we hired 2 more people, but it supported a much more significant increase in revenues, right? So the revenue per employee is 2,000 here. So here it dropped, here it went back up. But it's a good way to measure how efficient is my workforce. And you can start gathering this data and looking at it, and then comparing that with what your actual operations look like day to day. And you can start getting a sense of, again, this works in some business models, it won't work in everyone, but it's a good gauge to start with to look at, how do we know when it's time to hire another employee, right? If we gather this data very consistently and analyze it, we'll probably start to get a feel for that. We'll probably start to get a feel that every time we have this % increase in revenues, we might want to start looking at hiring an employee. Because similar to what I said about the quick and current ratios, that they look good as long as they're increasing, until you hit a certain point where all of a sudden it suggests another kind of problem, which is that we're not using our resources efficiently. You have a similar kind of thing that can happen here, where on the surface it seems like the higher this number is, the better. But what it could also suggest is that we're stressing our employees out and overburdening them. And that's not good. That's not good for company morale. It's not good for corporate culture. So with all of these things, it's important to remember that it's not on or off. There's a balance with all of these things. In other words, it's not always going to be good as this gets better and better. Because if we keep raising our revenue and don't hire any more employees, at a certain point, employees are going to start quitting, because they're going to, like I said, they're going to be overburdened and overwhelmed. So this is another ratio I really like to look at when I'm analyzing numbers with my clients this way. And I know that we have a bunch of accounting professionals here. I also know that a bunch of business owners had signed up. I'm not sure if many of them are here with us, but I'm guessing they're going to catch the recording. So I want to speak to sort of both groups and say, again, I want to stress that both should be together doing this analysis, the business owner and the accounting professional, because there's insights that need to be contributed from both sides to really make sense of this stuff. But speaking to the accounting professional part of this audience, if you're going to do this kind of stuff, and I highly recommend that you do, I think it's much more interesting, it's much more rewarding, and frankly, it's much more valuable. After sure, the bookkeeping needs to get done, but as many of us know, a lot of that can and should be automated by now. My whole first section of the Bulletproof Bookkeeping course, teaching you how to how to automate your bank feeds by creating detailed rules. And I mean detailed. I'm not talking simple, like if it's Staples, put it to office supplies. Those lessons in the course show you how to really do analysis and say, if it's Best Buy and if it's over 500, put it to fixed assets, and if it's Best Buy and it's under 500, put it to computer equipment. So I get more detailed so that you truly can see how in the bank feeds you can automate the business, so that now you can focus much more on this kind of stuff. And this is where, as the accounting professional, we can add a ton more value. Most business owners don't perceive having a good set of books as a whole lot of value beyond the obvious, right? It's a necessary evil. But this is where I can give a business owner some intelligence, like I just underscored by pointing out how you can start to look at how when it's time to hire an employee, or at least time to take a look at whether or not it's time to do that, whether or not we should, right? Looking at whether the company's going to be in trouble because they're getting less and less liquid, and especially if that ratio on, if the current or quick ratio ever turns from 1 to something less than 1, that often indicates a problem, especially if that's been the trend. I don't mind dips here and there as long as it bounces back. But if there's a consistent trend where we're getting less and less liquid, it's a red flag. It's something that says we need to take a closer look and find out what's going on. Are we not collecting our receivables? Are we locking up too much money in inventory and risking that inventory could be obsolete and never sold, which means we'll have to write it off, right? Is there inventory now that should be written off, right? Especially if we look at the balance sheet like we did in the beginning, if we see a steady incline in inventory and it's a dramatic one and it's been going on for a long time, there's a good chance that there might be inventory on the shelves that does need to get written off. And I'll ask those questions and I'll say to the client, and literally in auditing, we have a test that we would do when we would audit on site and go into the warehouse and this is no joke, this is a documented a procedure that auditors will perform to test the salability of inventory. Is we reach all the way to the back of the shelf and we swipe our finger over the top of a box and we look for dust. Right? And in other words, if it looks like there's stuff that's been sitting on the shelves for a really long time, then, that could indicate a problem. That could indicate that we have inventory that's never going to sell. I'm just reading Jalal's comment in the chat. As revenue per employee goes up, so does risk. Absolutely. In case you lose that employee, it can create even more stress to supply and demand. Really enjoy that ratio. One recent overhaul I brought to a client was profitability by item. This allowed him to find items that are actually losing money in a measure of gross profit. I did something very similar this year for a client. Hard to do, especially if we're talking e-commerce, right? Because we weren't just looking at what he paid for the products versus what he sold them for. We had to find a logical allocation for all of his logistics and shipping and other kinds of costs that really go into getting the inventory ready for sale so that we could truly determine profitability by item. And so it was a very detailed analysis. We had to pull data out of Amazon and out of QuickBooks and kind of pull it together. And then we ran some serious pivot tables to get it all grouped by item, because we had to do allocations. It was a pretty complex thing we had set up. But in the end, we were able to actually confirm what we already knew. And sometimes that's where the value really is. It's like you have a hypothesis, but you want to confirm it. So you run the numbers and you do the analysis. And it might seem like, well, if they only confirm what we already knew, how valuable is that? The answer is it's tremendously valuable, because if we didn't run the numbers, then you wouldn't be sure, and your decision-making process would be very different versus knowing for sure because you did take the time, you ran the numbers, you did the analysis, and you confirmed. I gave an example of this I think we were looking at it on my site earlier. Let me go back there for a second. I think it's about the third lesson in the Bulletproof Bookkeeping course. Let me go back here. Here, I'll look at we got the whole outline here. So yeah, it's this lesson, a little 3-minute video. I looked at this at one point and I almost said, maybe it's not worth keeping this. It's only 3 minutes. But then when I reviewed the video, I was reminded that this 3-minute video actually takes everything we did in really this lesson, the part 1, and shows you how to check your work and make sure using a certain formula and comparing what we have in a spreadsheet from the bank with what QuickBooks Online shows, the QuickBooks balances and the bank feeds. We do a little math to make sure that we can get to the same number. And I make the point that the difference between compliance and bulletproof is just that. In compliance work, which is just okay, not bulletproof, I wouldn't bother to do that, right? I would just go with it. I would say I imported everything, it's all mapped, it's good. But taking that one extra step to verify the number, to check your math, is exactly in many cases how you go from compliance to bulletproof on the stuff you're doing. And again, when you have that kind of bulletproof books in place, then you can really rely on the analysis that we've been talking about today. And that's kind of the name of the game here. If we really want to take this stuff into the future, if we really want to, and I'm talking to the accountants and bookkeepers in the group here, if we really want to become that trusted advisor who's really guiding our clients, this is the way we do it. We have to learn how to first make sure the numbers are reliable, which means get bulletproof books. And then we have to learn how to analyze those numbers, have the conversation with the client, let them provide the operational insights while we provide the financial insights. And then together, you've got a complete 360-degree picture of what's going on in the business. And now you can really project into the future with power and accuracy and precision. And then, of course, we just need a monthly review process to make sure that everything stays on track and on target with what we're trying to do and whatever goals it is we're trying to reach with the client. And I'll end with this. One of the things I've been stressing lately, because, oftentimes when I have these conversations with business owners and accountants alike, and we start talking about getting into things like projections, everybody loves to talk about projecting revenue and expenses, right? But of course, years ago, I came up with my whole cash flow projections process because I said, no, that's not enough. And I would see a lot of people doing what I call a check register projection, which is not a projection at all. It's just taking the checking account balance and saying, here are the payments that I know are coming in and payments I know we have to make. It's ignoring too much of the picture. A true projection has to include all the financial statements like we looked at today, the balance sheet, the profit and loss, and the statement of cash flows. It has to be projecting all three of those. And when we're doing that, we have the whole picture provided again by the combination of both accountant and business owner. And once that's all being done and reviewed on a regular basis, that's how you stay on track. That's how, as the accountant and bookkeeper of this day and age, you can really focus and stay focused on providing tremendous value to the business owner who, again, is maybe coming in your door and confused and saying, I don't understand. Why do I owe this money in taxes? I don't have the cash in the bank. And you can start by answering those questions. But then here's ultimately where I'm going with all of this. We want to go beyond just projecting income and expenses into projecting what amount of cash do I want to have in the bank at the end of 6 months or a year. That's the target that I think we need to be shooting for when we're doing this kind of stuff. It's not enough to project net income. You have to go a step further and also project retaining some of that income, not taking distributions, as we talked about earlier, or not taking as much, because really to build a viable business, to build a business that some other big company is going to want to buy, or a business that we can otherwise retire on somehow, to do that, we need to have a target in terms of the cash reserves. We need to build the equity section of the balance sheet up, and we need to build cash reserves so that we have the cash to take advantage of opportunities when we need to, and then we can do it without taking on debt if we can avoid it. Because with debt, there's the cost in the form of interest. So if we can avoid that, that's always the best. And I'll shut up now and stick around if anybody has any questions or thoughts or comments or things to share. Everybody's so quiet. If you are trying to say something, just make sure you unmute first. And if not, I'll wrap it up and I'll get the recording of this webinar up as soon as possible. I think I owe you all last week's recording too, for those of you who are on it. Andrea's in the chat. She says, very good. Have someone to try this out on. Great. Please let me know how it goes and let me know if you have any questions, about what you encounter when you do it. It is, again, to me, this is the way for accountants in this day and age to add real value for their business owner clients. The clients don't necessarily appreciate what it takes to actually do the books, even to keep them bulletproof. When they start appreciating that, really, is when they come to you and scrutinize and they say, I don't think these numbers look right, but then you can prove them, right? That's a huge confidence builder, actually. I've seen it happen firsthand where clients have questioned me on the numbers that I've put together. Years ago, I actually had a client say to me, he was only half joking too. He said, has anybody ever fired you for being too accurate? Because it was over some balance that he thought it was this. And, I had the exact number and it was like a difference of 45 cents or something silly like that. And that's when he raised that question. It's funny, but I hope you get that criticism from a client. I hope a client accuses you of being too accurate. They may complain about that if you're charging them by the hour, because they may feel like they paid too much in hourly fees for you to be that accurate. But that's the beauty of charging flat rates, on monthly services, is then they don't need to care how long it took you to get that accurate. In fact, if anything now, it's sort of a blessing for them to know that the numbers are that accurate, that they're bulletproof. So anyway, yes, projecting cash flow can be difficult for the entire year, but you have your formulas and your assumptions. That's why I love to use Giraffe, right? See this guy here? The company sent them to me. I've done it for years in spreadsheets. And the point is, you don't just do it for a year and forget about it and revisit it a year later. You do it and analyze it monthly, if not more often. One of the reasons I went to Giraffe was so that I could do it more often than monthly, because when the month is over, it's too late to do anything about it. But we can look at it, month to date versus actuals to see how close we're coming. But the point is, even if you just do it monthly, then that gives you the opportunity to say, okay, we were over in these areas. We were unfavorable in our variances here. We were favorable in other places, and you adjust the projections as you go. Because that's the biggest mistake I think people make when they do projections initially, is they do it once and then they say, okay, we'll see you next year. We'll see how we did. And that's no way to do projections at all. The point is to review them every single month, if not more often, so you can see where you've gone off track and then make the adjustments you need to make. And I had a client that one of the reasons I went to Giraffe was because I had a client who said, Seth, we always have good projections that show that we're going to accumulate so much cash in the bank, right? That's where the cash reserve target actually comes from, is my experience with this client, because it made me realize that's really the important target to shoot for. But he said, we never end up there. And I said, well, let's look at the record. We have the monthly variance analyses that I've done with him. And in the spreadsheets, I started laying them out side by side so you could clearly see month over month what was going on. And I was able to show him each month where we went over. And invariably, every month it was, his revenues are pretty predictable, but it was always expenditures. One month, I think it was actually last year, he bought a bunch of exercise equipment for his office. And I joked with him about it, but I asked him seriously. I said, "Are you using it?" He says, "Yeah, actually, I use it every day." I said, "Great, then it's a worthwhile investment, because keeping yourself and employees healthy is definitely a good investment that you can make as a business." But that was a big expenditure that we had not budgeted for. It wasn't in our projections, and that was just 1 month example. A lot of months there were other examples, usually tax time. That's when they take extra draws out because they need to pay their taxes. Again, perfectly acceptable, but that's also easy to plan for. Right? We can plan those kind of draws out, and I do that with him. But the point is, I said to him, the only way we're going to be able to hit our cash reserve targets is if we don't go over our budget in terms of net cash flow. So by having Giraffe, what we're able to do is we're able to now analyze the month-to-date actual compared to the variance. And so if I can see that we're going over on a certain expense, I can look at it before the month is over and say to him, all right, first of all, moratorium there, stop spending money there, and or let's look elsewhere in our budget and see where we're under by at least as much. And we can say we're going to take it from there. Because I said to him, net, it doesn't really matter cash flow wise. Of course, business wise, it's important to understand where the money's being spent. But in terms of hitting the cash reserve target, as long as we stay with the projected net cash flow, then we'll hit the target every time. It's simple math. Right? And that's the key. And now it's hard as the accountant to get the business owners kind of to stay sort of grounded in this. A lot of them, will have those meetings with you and say, yeah, this is great. We got to do it. But then they keep going and doing what they're doing. This guy with me in this case is really kind of bent on actually sticking to it. And that's what, as the accountant, you have to get out of your client, is you have to kind of nail them down on the fact that if they want to hit the targets that we've laid out for them, the only way that's going to happen is they stick to it. Right? And there's lots of ways, again, to keep that trajectory in place which starts with looking at where we've gone over and seeing where we've come under to make sure we can balance that out. And it may not be that we can do it within the month. Maybe, maybe they really felt it was a great idea to spend a lot of money on equipment, but then we need to look into the next month and see where can we make that up, so that maybe not within the same month, but over a 2-month period, we can kind of make up for it, so that ultimately we stay on track with meeting that target. That's the key. And I think that's the thing a lot of people miss, is they'll set up the projections in the beginning of the year, and then they really don't pay attention to them. I have a weekly meeting with this client in which we review what's in the projections. It's for an hour a week. Every Thursday morning, I review it with their bookkeeper, and now he's getting involved more and more on the weekly calls, because it's at that point where I told him, I said, you want to hit those cash reserve targets? I need you involved. I need you looking at this with me. I need you aware of when we're going over or in danger of going over somewhere, because you're the one who can control that. I can't. I'm not writing the checks, right? All I can do is look at things with him, in some cases after the fact. But that's how you project out for a year. If you're doing projections for a financial institution like a bank or a potential investor, a lot of times they're going to ask you for a 5-year projection. So you just do it, and you make your assumptions the best you can make them, knowing full well that anything more than a year out is going to be highly inaccurate, because so much can happen between now and then. But again, at that stage, I think of it not so much as an expectation as much as I think of it as a target, as something I want to shoot for, right? I want to turn monthly income or annual income into monthly income, right? Picture that for a minute. Sit with that thought for a minute. It sounds crazy, but it's not. I mean, it's when you start thinking about it, it's actually a great way to start off with your revenue targets, at least, is think, could I do that? If I'm making whatever, 100 grand a year, how can I turn that into 100 grand a month? It sounds outrageous, but the more you think about it, the more then you start to think in terms of, how do I provide 100 grand a month in terms of value? Because that's how you do it. And you could do it by selling a really high ticket item, and you can sell 2 of them a month for 50 grand a piece. Or you have a service that you offer that's worth $1,000 a month, and you need to find 100 clients who are diehard fans of that service, and we'll each pay you the $1,000 a month, and that's how you get to 100 grand a month. And then, of course, you have to scale and hire people to help support that, so you don't get to keep the whole 100 grand a month, but you'll get to keep a whole lot more of it than what you're keeping out of the 100 grand a year, right? So this is how I've learned to sort of shift my thinking, especially when I get into this stuff, right? Getting into this stuff helps me kind of open my eyes and open my mind to what those sort of possibilities might look like. And I start by thinking really big and like almost outrageously big. But then the more you do that, the more you start, the more that kind of big thinking sort of has a way of settling down to just like, okay, this isn't normal. It's not so far-fetched. Maybe I can actually get to 100 grand a month one day. And maybe that's more than you ever want to do. Maybe your interests are simpler than that. You just want to make a good living so you can go out and have fun, and that's totally respectable. I'm not telling you how to do things. I'm just trying to open people's eyes up to the possibilities and seeing what you can do and how you can do it. And the bottom line is, the more of this stuff you do, the less time you'll have to put in. And I can almost guarantee you that you'll make more money working fewer hours. I've actually cut back on my hours this year, because I'm doing more of this kind of stuff, and of course the course and content development stuff I'm doing more of, and less of the consulting. Because as an accountant, the consulting work, and by consulting I mean where we're doing the books for other companies, it eats up a lot of time and resources, right? This stuff I can easily show up for in a fraction of the time, provide probably twice the value. So clients are happier, I'm happier, and I'm working less hard, and I'm making more money, and I'm more comfortable. And that's the name of the game, I think, for all of us at the end of the day. And that is my story, and I'm sticking to it. So again, if you have follow-up questions or anything like that, let me know. You know where to find me. I'll be happy to answer them. If you haven't already signed up for Bulletproof Bookkeeping, BB25 will get you 25% off the price of the course. And I believe that's only good until November 1st, and then we're raising the price again. So hurry up and tell your friends if you haven't already signed up for it. And I will see you all. Have a happy Halloween. And I'll see you all maybe Friday in our Friday Zoom.